So, how do you really know if a market that's shooting for the moon is about to come crashing down? It's one of the toughest, most expensive questions in all of finance. In this explainer, we're going to break down a really fascinating two-step method from the quant research firm 20Quant that might just give you a serious edge in figuring it out.
Look, every investor knows this feeling, right? You see a sector just rocketing upwards, and you're stuck with this huge choice. Do I jump on the rocket ship, or do I brace for impact because this thing's about to pop? The stakes? They honestly couldn't be higher.
Okay, so let's start with something that might actually surprise you. It's a totally counterintuitive fact. The vast majority of market sectors that have a massive run-up, and we're talking about doubling in price, they don't actually crash. Nope, they just keep going, or they level off. And that, right there, is the big question, isn't it? If most of these huge run-ups are actually safe, how on earth do you pick out the really dangerous ones? How do you separate the real, sustainable growth from that speculative frenzy that's just doomed to burn out? All right, so the first piece of the puzzle, it involves looking at the visible signs. You're looking at the very shape and the rhythm of the price increase itself. You can think of this as like the initial symptom check. And the tool they use for this is called the LPPLS model. It's basically a pattern recognition machine. It scans all the price movements, and it's looking for a very specific mathematical signature of a bubble that's forming. That telltale sign in the data that things are speeding up way too fast to be sustainable. But, and this is a huge but, the LPPLS can tell you if something looks like a bubble. If it has the right shape, the right structure, it cannot, however, tell you if that bubble is actually going to pop. And that's a totally different question that needs a totally different tool. So if the first model is just spotting the smoke, how do you find the actual fire? Well, to get the whole picture, we have to go beyond just the surface level price and really look at the underlying health of the sector. This is the deep dive, the real diagnosis. And for that, 20Quant brings out the GSY model. Now, this has nothing to do with the shape of a price chart. This model gets its hands dirty, diving right into the sector's fundamentals to calculate the actual, quantifiable probability that this whole run-up is going to end in a spectacular crash. So what do we actually mean by fundamentals here? Well, the GSY model digs into the hard data. It's asking the tough questions. Are the companies in this sector really growing their revenue, or is it all just stock price hype? Are they frantically issuing new stock just to cash in on all the excitement? It's all about separating real business growth from pure speculation. And this is where it all comes together. This is what makes this whole approach so incredibly smart. It's not about picking one model or the other. It's about combining their two very different signals to get one much, much clearer answer. And this chart, it lays it out perfectly. The LPPLS is basically asking, does it look like a bubble based on how the price is behaving? It's the visual check. But the GSY asks a deeper question. Is this thing likely to burst based on its underlying health? It's the medical diagnosis. Two different questions, and you absolutely need two different tools. So here's the real magic. When the LPPLS model is screaming, hey, this looks like a bubble, and the GSY model comes back and says, yup, and this thing is fundamentally sick and very likely to crash, that's when you have a warning signal that is so much stronger, it's practically impossible to ignore. But you know what? Don't just take my word for it. Let's hear how the firm's own managing director sums up this two-pronged attack. And there you have it. Federico Policies just nails it. It's all about having the right tool for the right question. One model is looking at the structure. The other is calculating the cold, hard probability of a crash. Okay, so this all sounds great in theory, right? But the big question is, does it actually work in the real world? Well, this is where the firm really leans into what they call their no shortcuts approach to making sure it does. Before any model is ever used, it has to go through this entire grueling pipeline. They start with deep, deep academic research. Then they reconstruct all the math from the ground up, code it themselves, and then they just relentlessly test and validate it against decades of historical data. And when it came time to test that GSY model, they really focused on this one number, 127. Now that's not just some random number. That's how many distinct historical sector run-ups they identified and dug into to make sure this model was effective. We're talking about analyzing nearly 4 decades of market data from the S&P 500, just to be sure the signal was real.
So, what's the big takeaway from all of this? Why go through all this trouble building and combining these super complex models? Well, it really comes down to a fundamental and crucial distinction.
And that, right there, is the whole point of this entire exercise. It's not about predicting the future with 100% certainty, because that's impossible. It's about giving investors the tools to understand a developing risk, a potential bubble, long before it turns into a catastrophic, irreversible loss in their portfolio. Which kind of leaves us with one final thought, something for you to think about. It's not just about getting the answers, it's about making sure you're asking the right questions in the first place. So, are you just looking at the price, or are you actually looking under the hood?